Are your fair value gap strategies missing something crucial? What if I told you there's an overlooked concept that could level up your entries and boost your win rate dramatically? Stay with me, because in this video we're diving into advanced FVG techniques that most traders ignore but smart money respects. Trust me, you'll never look at fair value gaps the same way again after watching this video. You'll learn how to spot the most effective entry points using FVG and inversed FVG, and I'll also share a proven trading strategy built entirely around inversed fair value gaps, a method that could seriously boost your win rate. Make sure to watch the whole video as we break everything down step by step, giving you all the knowledge you need to master FVGs and elevate your trading game. If you find this helpful, give the video a thumbs up and subscribe to the channel if you're new. See you after the intro. Welcome back, traders. Fair value gaps, or FVGs, are a powerful tool for understanding market behavior. They often highlight key areas where price movement can be anticipated, making them incredibly useful for shaping trading strategies and pinpointing potential entry zones. That's why grasping the concept of FVGs is so important. Now, we've already put out a few videos explaining the basics of fair value gaps and how they appear in market structure. But today's video takes a new angle. We're going to explore advanced FVG concepts, details that are often missed or overlooked. First, we'll quickly revisit the structure of traditional fair value gaps and their variations. Then we'll dig into the psychology that drives price to revisit and often reverse at these levels. But the real spotlight today is on a more specialized concept: inverse or inverted fair value gaps. You'll learn what they are, how to spot them on the chart, and most importantly, how to use them to your advantage in real trading situations. All right, let's break down the fundamentals of a standard fair value gap. A fair value gap typically appears on a chart when there's an imbalance in price delivery, specifically when the market moves aggressively in one direction without pausing. This kind of sharp movement creates what's known as inefficient price action. In simple terms, it leaves behind a gap in liquidity, a space the market algorithm will often come back to revisit in order to restore balance. These gaps usually show up in a sequence of 3 candles. The key visual clue is this: the wicks of the candles before and after the middle one don't fully overlap its body. That gap, the space between those wicks, centered on the middle candle, is what we call the fair value gap zone. What's happening here under the hood is this: when the market rushes toward a price level, large institutional players or smart money push in a massive volume of orders all at once. This sudden surge causes a disruption between buyers and sellers, throwing the market out of equilibrium. The result? A clear displacement in price, which manifests as a fair value gap. Let's take a closer look at how bullish and bearish fair value gaps actually function on the chart. When a bullish FVG forms, the gap between candles, where their wicks don't touch, represents a shortage of selling activity. In simple terms, there weren't enough sell orders available to match the incoming buy orders at that moment. This leaves behind unfilled buy orders within that price zone. On the flip side, when we spot a bearish fair value gap, it indicates the opposite. There weren't enough buy orders to absorb the heavy sell orders coming through, leaving unfilled sell positions behind. These leftover orders become critical. They're often the reason why price revisits these zones later and frequently reacts or even reverses direction there. So what's the psychological reason behind this price behavior? Why do these gaps command so much respect from the market? Let's consider a simple 3-candle sequence that forms a bullish fair value gap. Imagine this structure formed on a higher time frame. Now, if we zoom in and analyze it from a lower time frame, we'll often see that this move created a clear bullish market structure. The price surged upward with strong momentum, fueled by aggressive buying and very little selling resistance. And here's the important part: the market doesn't like imbalance. It naturally tends to go back and rebalance those inefficient zones. That's why fair value gaps act as magnets for price. They hold leftover orders that the market wants to revisit and fill. When traders see a strong move happen on the chart and miss the initial entry, they often try to catch the next opportunity by placing buy limit orders just below important areas like demand zones or order blocks. Their goal is to enter the market if the price makes a deeper pullback before continuing its upward trend. What this behavior does, though, is it clusters a large number of pending buy orders in a specific area, usually within or around the fair value gap. These pending orders form a liquidity pool, which attracts price action back into that zone. Fair value gaps, then, are more than just empty spaces. They often contain a heavy concentration of buy or sell orders. This pool of liquidity is what draws the market back to those levels, making price more likely to return, fill the gap, and then continue its original trend, sometimes with even stronger momentum. So from the perspective of the algorithm that drives price behavior, these gaps act like magnets, pulling price in to clear the imbalance and tap into that built-up liquidity. And for us as traders, that moment of return can offer a high probability entry point aligned with the market's true intent. From a structural point of view, fair value gaps can be classified into two distinct types. The first is known as BC, which stands for buy-side imbalance, sell-side inefficiency. This occurs when price surges in one direction, offering almost exclusively buy-side activity. The algorithm aggressively pushes the market upward, leaving little to no opportunity for sellers to participate. As a result, a gap is left behind. This is what we call a BC-type fair value gap. To restore balance, the algorithm will later introduce sell-side activity, often in the form of a bearish candle. This action gives sellers a fair entry and helps return the market to a more efficient state. On the other hand, the second type is called CB, which stands for sell-side imbalance, buy-side inefficiency. It's essentially the mirror image of BC. In this case, the market drops rapidly, dominated by heavy selling, with very few buy orders to offset the move. That lack of buying activity leaves behind a fair value gap. To fix this, the algorithm will eventually introduce buy-side delivery, allowing buyers to step in and bringing the market back into equilibrium, just like it does in BC scenarios, but in the opposite direction. Within every fair value gap, there are three important internal levels to pay attention to: the high of the fair value gap, the low of the fair value gap, and the midpoint, commonly referred to as consequent encroachment. Each of these levels can serve as strong support or resistance zones, especially when analyzed on lower time frames. But the most crucial of them all is the midpoint, the 50% level of the gap. That's the level we focus on the most. Here's how it works in practice. If price revisits a fair value gap and respects the midpoint, it's a sign that price may reverse and continue in the original direction. For instance, if price enters a bearish FVG but fails to break above the midpoint, it's likely to move lower. However, if price violates the midpoint and closes beyond it, especially in a bearish FVG scenario, that's a strong signal that the market could continue pushing higher. It's a key level for interpreting price intention. If you want to take your trading to the next level, check the description for more powerful trading resources, guides, and tools to help you sharpen your edge. Now let's introduce a slightly more advanced idea, the inversion fair value gap. So what exactly is an inversion or inversed FVG? It's a fair value gap that has been invalidated, meaning instead of price reacting to it, price breaks through it entirely. Once this happens, the gap often changes its role and turns into a support or resistance zone depending on the breakout direction. Let's say we have a bearish FVG and price doesn't respect it. It pushes right through. That zone now switches roles and is likely to act as support, turning into what we call an inversion FVG. This concept follows the same logic as demand and supply zones. When price breaks a demand zone without reacting to it, that zone often flips and becomes a new supply zone, and vice versa. The same behavior applies to fair value gaps. For a clearer understanding, let's look at an example. Here we have a bearish CB fair value gap that price initially respects. However, price breaks through the gap with two bullish candles, turning the fair value gap into an inversed fair value gap. Now, what we expect is that price will either retrace into this new zone or continue pushing higher. If we play out the chart, we can see that price does indeed retrace into the inversed FVG, respects the consequent encroachment, and then continues higher. This example demonstrates how fair value gaps can change their behavior, shifting from resistance to support in certain scenarios and guiding price toward the next move. Now, let's talk about the inversed fair value gap strategy. Let's take a look at a real chart to see how we can use inversed fair value gaps for trade setups. On the screen, we have the GBP USD on a 1-hour time frame, and the general market direction is bearish. We can see that price has swept buy-side liquidity above the structure, filled the inefficiency, and then reversed. Now, I'll zoom into the 5-minute time frame to search for a bullish inversed fair value gap, or BC, that's been violated. Looking closely after the buy-side liquidity sweep, price violates this bullish fair value gap and closes below it. This gap is now more likely to act as resistance rather than support. Additionally, we can spot a market structure shift at this point, which further confirms the potential for a reversal. With these two key confirmations, price breaking the gap and the structure shift, we can anticipate a return to the inversed fair value gap zone before price continues its move toward the sell-side liquidity. When it comes to placing an entry, there are two strategies to consider. The first option is to place a sell limit order at the lowest point of the inversed fair value gap. The second option, which tends to offer a better risk-to-reward ratio, is to place your entry at the consequent encroachment, the 50% level of the inversed FVG. For your take-profit levels, target the nearest liquidity zone within the current time frame. As you can see, the price pushed higher, tapping into the inversed FVG, which acted as a strong resistance zone, triggering my sell order. From there, price reversed and moved downward with strong momentum, ultimately hitting the take-profit target and confirming the effectiveness of this trading setup. Let's move on to another example to reinforce this concept. Here we're looking at the 1-hour time frame, and as you can see, price has swept the sell-side liquidity below the previous low. With the sell-side liquidity cleared, the market is now likely to shift focus toward the buy-side liquidity, aligning with the bullish market profile. Next, I'll zoom in to the 5-minute time frame for a closer look at the price action and to pinpoint a suitable entry for a long trade. On the 5-minute chart, we can see that after clearing the sell-side liquidity, price re-enters the range of the previous major low and closes above this bearish fair value gap. This action transforms the gap into an inversed bullish fair value gap. Now, we can anticipate that price will retrace into this bullish inversed fair value gap zone before moving toward the upper buy-side liquidity. For my trade setup, I'll place my sell limit order at the highest point of this inversed fair value gap. My stop loss will be placed just below the swing low, and for the take profit, I'll target the next liquidity zone above. As you can see, my order has been triggered and we're officially in the market. In the end, the trade played out successfully, reaching the take-profit level. That's it for today, traders. I hope you found this video both informative and helpful. Don't forget to subscribe and turn on notifications so you never miss an update on our latest content. We truly value your feedback, so please drop a comment below and let us know what topics you'd like us to cover in future videos. Thanks for your continued support, and we look forward to seeing you in the next video.